Hey, welcome to episode 3 in our series of Velocity Banking in 6 minutes or less. In this episode, we're going to talk about chunking. So if you haven't already seen episode 1, go take a look at it where we talk about the difference between loans and lines and why that's fundamental to understanding velocity banking. Episode 2, we talked about getting a debt tool. So that's the tool, that's the means of moving things from loans to a line or consolidating everything and paying off all these small little debts. And in this episode, we're going to talk about chunking. But before we get right into it, if you already haven't done so, make sure you head over to the website, myvelocitybanking.com. Sign up for a free account. Enter all your information, including your loans, including your expenses, your debts, and of course, your income to figure out to get a debt payment schedule and to figure out how long it's going to take you to get out of debt. And this is all free with the free. This is all with the free account. All right, so we're going to get into chunking. So chunking is probably the most controversial part of velocity banking because it seems like you're not actually paying anything, that you're just moving money around, but you still owe the same amount of money. But that's not how chunking works. So with velocity banking, the concept of chunking is being able to move a loan to a line, and you do that via your debt weapon. And then once you've done that, then you chunk that, and then you pay off the actual debt tool that you're using. So the chunking part is how much you actually pay off of your debt tools towards this other towards all these other loans or lines or debt that you're actually trying to pay off. So we're going to use an example because that's going to be more valuable in understanding how chunking actually works. So where this person has Chase mortgage, Citibank credit card, and Amex. They have to pay off their grandparents, they have to pay off their car, and of course they've got some medical bills to pay off as well. Now we're going to see how the chunking actually works under this scenario. Now, to different scenarios will have different chunking amounts. Now this person happens to have a high cash flow, so they can do larger chunks because they have a higher cash flow. So let's take a look at what that actually looks like. So it breaks down, so the application breaks down, your debt, how much each debt is like costing you, and then what to actually use as your debt tool. Now, what we talked about in episode 2 is that you don't have to figure this out. You don't have to, think about which tool should I use, because the application will look at everything and then it will figure out which tool is like best for you to actually use. So in this person's case, it said it was their Amex. So the way that chunking works, it breaks down the chunk. It says, listen, make this chunk towards your grandparents, pay off your medical with the next chunk, and of course the Amex, you just pay off your Amex with that chunk, and you make a $10,000 payment towards your truck as well. And that all goes to the almost $20,000 in chunk payments that this person can make. Then the person takes the next 12 months paying off their Amex card and paying off the actual total chunks that they have made. And then they can also make a partial payment to their Citibank credit card. And then they just make their regular payments like usual to their credit card. And they've taken a year to actually pay off this credit card, which is why they don't get to do anything till next year in this scenario. And of course, which seems really counterintuitive because you're using money from one person to pay off another person. But the goal of this is that you're minimizing interest. So here's how much interest you actually pay by doing all of this stuff. So this is how much interest you're going to pay in a year. And you might actually pay even less because as you're paying off your Amex card, in this case, you're not actually paying interest on the total amount. You're just paying it off a little bit fast. So each month that you pay off more, you're paying less in like interest. So in this person's example, they'll take a year to pay off all their debts, all their non-mortgage debts using the chunking method, and then they can tackle their mortgage using the exact same idea of like chunking. Now, there's always a question because most banks won't let you pay your mortgage with a credit card. But I made another video as to how to get around that, how to actually get your credit card in a roundabout way to pay for how to actually pay your mortgage with your credit card. So look for that video I made. And then you just keep chunking it. The same idea. Now you'll see that their chunk payment's a little bit higher. Why is that higher? Because now their cash flow is increased because they've paid off all their debts. So they don't have as much debt to pay off each month. So that increases their cash flow. And increased cash flow means they can make a bigger chunk payment. And a bigger chunk payment means it's going to take less time to actually pay off their debt. So in this example, they're just making chunks every year. And then they just do their regular payments. And then next year they make another chunk and so on and so forth till their mortgage is paid off, and then also calculates how much interest they actually paid. Because you'll always pay interest regardless. But the goal of Velocity Bank is how can I minimize that interest I pay and get out of debt faster. All right, so that's it for episode 3. Make sure you like and subscribe to this channel and hit the notification bell because there's going to be more show episodes coming up in this series of Velocity Banking in 6 minutes. All right, talk to you next time.